Welcome back to the deep dive. Okay, so today we've got the full stack, haven't we? Press releases, the earnings call transcript, all the numbers for Shree Cement Ltd's Q2 FY26. A major player.
Absolutely. And the mission really is to cut right to the chase for you. We want to quickly pull out the key insights on, well, three main things.
Right.
First, how did they navigate the monsoon quarter? Because usually that's tough. Second, what's their play with the big GST rate change? And third, this massive 80 million ton capacity goal. What's the real story there?
Exactly. And we have to start with those headline numbers because, honestly, for a monsoon quarter, they look kind of stunning. You normally expect everything to slow right down.
They really do. Net revenue up 15% year on year. That's 4,303 crore. And operating profit, the EBITDA, jumped 44% to 151 crore. Pretty solid.
But the one that really makes you go, wait, what? Is the profit after tax. P&A didn't just grow, it exploded.
Yeah.
Up 198% year on year, landed at 277 crore.
198%. That's, well, it's huge. It begs the question immediately, don't it? How did they manage that? Was it just good operations, or is there something else going on there, especially given the season?
Okay, let's unpack that strategy then, because looking through the materials, it wasn't just about selling more cement. Volume did go up, sure, about 6.8% year on year.
Right.
But the real story seems to be their focus on value over volume. That phrase came up.
It did. That was the core message. Focus on realization, getting a better price for every ton they sold. And you see it clearly in their product mix. They made a really big premiumization push, as they called it.
And we can see the numbers on that push.
Yeah.
The share of their premium, higher margin products in the trade channel, so not industrial sales, jumped from, what was it, 14.9% last year?
Yeah, 14.8.
To 21.1% this year. That's a significant shift in mix.
It really is. And that 21.1% is clearly driving the financial performance. You see it directly in the realization per ton. It went up from 4,451 last year to 4,840 this quarter.
So they got the market to pay more, even with the rains.
Seems like it. They managed to hold on to or even increase pricing power through that premium focus.
Okay, and that naturally flows into the EBITDA per ton, which everyone watches in this sector. The adjusted number is pretty impressive, up 43% from 772 per ton last year to 1,105 this year.
Right, and that adjustment is important context, like you said. You need to be aware of this if you're digging into the numbers. There was a small one-time write-off, about 30 per ton.
What was that for again?
It was related to some power transmission assets they transferred to a government entity. So you strip that out, and the underlying operational lift, that jump to 11,105 per ton, looks genuinely strong.
Okay, but let's keep perspective. The monsoon did have an impact. You can't just ignore it if you look sequentially, quarter on quarter.
Yeah, the QOQ numbers tell that story. EBITDA was down 31% from Q1, and volumes were down 12%.
Which is expected, right?
Totally expected. And management was upfront about it on the call. They pointed directly to the heavy rains, especially in North India, messing with logistics and construction activity. The key thing isn't that it dipped, but that they managed to maintain those higher realizations despite the lower volume. Resilience, maybe, not immunity.
Got it. Okay, let's switch gears. The other massive factor hitting the whole industry, this GST change, the documents confirm it. Rate down from 28% to 18%. Effective September 22nd, 2025. That's huge.
It's transformational, really. And the company confirmed very clearly they passed the entire benefit onto their customers. No pocketing the difference there.
Which is good practice, but what's the bigger strategic thinking behind it? Is it just about being fair, or?
Well, the longer-term bet is definitely demand stimulation. The thinking is you combine this big tax cut with hopefully stable inflation and decent employment, and it should really light a fire under infrastructure spending. And crucially, they expect a big boost in housing, especially for low and middle-income buyers and in those growing Tier 1 and Tier 2 cities.
Right, that makes sense on paper. A 10% price drop should spur demand. But management seemed a bit hesitant on the call, didn't they? They said something like it was a little too early to see a big immediate bounce back.
Yeah, that caution was interesting. You'd think pass on 10%, demand jumps. But their explanation was timing. Q3 started right when major festivals like Chaff were happening.
Ah, so labor shortages, construction stops.
Exactly. Labor goes home, sites pause. And apparently this caused, in their words, some slippage of prices happening across India right after the GST cut kicked in. So the immediate effect was maybe muted by the holidays.
Okay, so the full demand impact is maybe still coming as things normalize post-festivals. So what's their plan for pricing now going forward? Stick with the premium push.
Seems so. They emphasized stable pricing. They pointed out their year-on-year price growth was actually 9%, a solid increase. Their strategy, tying back to that premiumization thing, is to use their brand strength to close the price gap between their main brands and the top competitors. Better margins across the board, basically.
Gotcha. Now, something that really jumped out, maybe a bit hidden in the details, the UAE operations. This felt like a real standout performance.
Oh, absolutely. It's easy to overlook the international bit, but it was firing on all cylinders. Their best ever quarterly performance, they called it. And the numbers back it up.
What were they?
Volume growth was huge, up 34%. Went from just under 1 million tons to over 1.3 million tons. But the profitability, wow, EBITDA soared 158%.
158%.
Yeah.
From the UAE unit alone. How?
Smart tactical shift. They used to sell a fair bit of clinker, which is like, semi-finished cement. Now they're converting more of that clinker into finished cement right there in the UAE.
Higher margins on finished cement.
Much higher. Plus, there's strong local demand in the UAE. And they're not just selling standard cement either. They're making specialized stuff like oil well cement and exporting it to good markets, Middle East, Europe, even North America, diversifying nicely.
And they're funding their own expansion there too, right? The notes said the new mill in debottlenecking.
Yep. Fully funded by the cash generated by the UAE unit itself, which is a really important point for valuation,
How so?
It means the consolidated result, the numbers that include the UAE, are becoming the, let's say, more authentic picture of the company's health. The earnings per share, the EPS, is significantly better when you look at it consolidated thanks to this strong international performance.
Interesting. Okay, let's bring it back home. Domestic expansion. The big goal is 80 million tons per annum. 80 MTPA. That's just massive. What's coming online, like right now or very soon?
Yeah, 80's huge. Near term, three main things. A big clinker unit, 3.65 MTPA, just started up in Jaitarn, Rajasthan.
Right.
The matching cement mill there, 3 MTPA, is expected very shortly. And then there's the integrated plant down in Kodla, Karnataka, another 3 MTPA that should also commission this quarter, Q3.
So a lot of new capacity hitting the market soon, which brings us back to that value over volume strategy. How do they square that with adding all this massive new capacity? They budgeted, what, 3,000 crore a year for FY27 and FY28?
Yeah, roughly 1,000 crore per year. And that's the core tension, isn't it? Management did say the 80 MTPA timeline is flexible, could be FY28, could slip to FY29. It depends entirely on how fast demand picks up and how well they utilize the existing capacity. They're definitely building ahead of the curve.
But if you bring, say, 10, 15, 20 million tons online, and that GST-driven demand takes, I don't know, a few quarters longer than expected to really kick in, won't they be under huge pressure just to sell something? Could that premium 21% share slip?
That's the tightrope. Exactly. Maintaining premium pricing while absorbing that much new volume, it hinges completely on that demand scenario playing out. If demand lags, the market gets crowded fast, and their price discipline gets tested, immediately. Their whole bet is on infra and housing really taking off in the next year or two.
Fascinating challenge watch. Okay, let's quickly touch on sustainability. It's becoming such a big deal for investors. What stood out there?
The green power numbers are really something. They're claiming 63.15% of their total power consumption in the first half of FY26 came from green sources.
63%, wow.
Yeah, and they claim that's the highest in the Indian cement industry. It's a major differentiator.
And why does that matter, beyond just, being green?
Cost stability, mainly. Green power, especially solar and wind they generate themselves, gives them much more predictable energy costs compared to relying solely on grid power or volatile coal prices. Their total green capacity is now over 600 megawatts.
Impressive. And water, too.
Yep. All plans are zero liquid discharge, ZLD. And their water positivity index, basically how much more water they replenish than they consume, is now over 8 times. Strong ESG credentials there.
Okay, and quick hits on new ventures. Ready Mix Concrete, RMC.
Ramping up fast. It's a key diversification. 24 plants running now. They just entered East India in Raipur, and the goal is ambitious. 40 plants by the end of this fiscal year, FY26.
And they did something interesting with solar there, too.
They did. Commissioned India's first RMC plant powered by solar at their Jaipur facility. It signals that their green focus isn't just for the big cement plants, it's for everything they do, setting a standard.
Right. One last efficiency point, logistics. You mentioned saving money there.
Yeah, that rail piece. They're pushing hard to shift more outbound cement from trucks to trains. The target is to go from around 11% rail share now up to 20%.
And the saving potential.
Management estimates around €100 per ton, which, when you're talking about millions of tons, adds up to serious money. It boosts the bottom line directly, helps cushion against any price pressures, too.
So, wrapping up this Q2 deep dive, amazing results, driven by that premium push, a surprisingly strong performance from the UAE, and this clear commitment to efficiency and green leadership.
And, maybe as a sign of confidence or responding to investors, they announced their highest ever interim dividend, €80 per share, using some of that cash pile.
Right. Which brings us to that final thought for you, the listener, to chew on. They've shown value over volume can work, even in a tough quarter. But now, with this massive 80 MTPA expansion plan rolling out and billions in CapEx, the question is, will the market demand, turbocharged by that GST cut, show up fast enough to absorb all that new capacity without forcing them to sacrifice their premium pricing? Can they keep that 21% premium share stable while adding so much volume?
That's the balancing act. Growth versus price discipline. It's going to be the key story for them over the next couple of years.
Indeed it is. Well, thanks for digging into this with us.
Always interesting.
We'll catch you on the next deep dive.